I think the main question on my mind is, do we resume kind of what the markets were doing going into the Iran war, or do we stick with this? So when I hear you and O'Hanlon and some of the energy people, I think, well, this is going to be an energy trade. Watch out for the consumer. I mean, there's sort of like those knock-on effects. But then we look at what's happening today, which tells you, no, when this conflict recedes, even if they say it hasn't, that you go back to the playbook of the first 8 weeks. Gold is higher, the metals are higher. You know, am I drawing too much of a distinction there?
I think on the commodity side, with respect to crude oil, we're not going back to $65 if this ends tomorrow.
And if you're a homeowner or home buyer, that's not the news that you wanted to hear. So, folks, my name is Dan Frio. I'm the host of the Rate Update, and I'm also a licensed mortgage loan officer in all 50 states. My goal each day is to help explain to you guys what in the heck is going on with those and the whys behind it. So we had mortgage rates drop a little bit yesterday. Why? Well, oil dropped, and we had the Dow Jones at one point up 1,000 points. Today, it's looking like a little bit of a different picture. So what's going to happen today with rates? Well, let's get over to today's news. The first thing I want to start out was right through here. And the reason why I'm doing this, I know I do this a lot, is these are the components we normally look at. Okay, this is what the Federal Reserve looks at. This is kind of what the markets look at. This is specifically what the bond market looks at to figure out where interest rates are going to go. Okay, so they look at inflation. The Fed uses the PCE. I use the CPI, but that's been running hot, and we expected that. And it's even going to run hotter now with oil. Okay, so then you got the unemployment rate. This has been sticky. You realize this has been about 4.4 per about 2-3 years now. That's pretty good news. But GDP, it's kind of taking it on the chin. That's a production in our economy. But the big news right now, and the only thing you really have to follow is oil. So where oil goes, here's what's going to happen. Oil's going up as it hits $100 a barrel and even higher. You're going to see stocks kind of plummet. We've seen that over, the Dow Jones was at $50,000 or 50,000 right before the war started. Now at 46. That's a little bit of a haircut there. And we also saw mortgage rates jump. So what to expect, like the young lady asked, once the war's over, where's things going to go from there? So let me give you my thoughts on this, and then we'll data check this maybe a week or 2 or 3 from now, even several months from now, to see how our projections were. So here's my thoughts on all this. So let's start over here. We want to start with oil. Okay, oil right here, it is up 3% today at $93 a barrel. That's bad news. Okay, oil, you realize oil was at $60, $65 a barrel just 3-4 weeks ago before all of this. But if you really take a dive into oil, and we're going to do that in some upcoming videos, you realize oil, even at $89 a barrel and $93 a barrel, this isn't as high as it's been over the last few years. We've been at $80 a barrel, $70 a barrel consistently throughout years. So we're going to talk about that, take a little bit of a deep dive into that coming up in the next couple weeks. But you have to really understand oil, because as oil goes up, you're going to see rates go up, and you can see the markets basically crumble. And then you really, if you want to, take a glimpse at cryptocurrencies. The reason why I follow this gives me kind of the risk threshold on Wall Street. So let me say this. During COVID, when people had a ton of money, people just bought into these things. Why? They had excess money. This is probably some of the riskiest investments you can have. So when I start seeing Bitcoin rallying, I'm not thinking, okay, there's some technicals behind it. I'm just thinking, okay, people have excess money. They want risk on. They want those high returns. So they jump into Bitcoin. So when I come into the markets each day, the first thing right now what I look at is I look at oil. And if I see oil up, I know it's going to be a bad day. So then I go over to the pre-markets or what the markets are doing. That usually follows suit. Oil up, everything down, and then, you have interest rates going up as well. If you really follow mortgage rates like I do, let's get over to see how I track these, and I can put a little more context in this as well. So here's the bond that we follow on a daily basis to figure out what's going on with mortgage rates. Okay, all you have to understand is that number right up through there. If it's red, that's not good. That means mortgage rates are going up. So here's what's happened yesterday and today. This is what we call a gap. This is bad. Remember I said when it goes down, that means mortgage rates go up. So this is a gap. Many times what happens is the gap gets filled. Well, let's hope it does, because a minus 23 is going to push rates up considerably over 6.5. I don't think they'll get to 6.6. My goal right now is just if we can stay at 6.5 and between 6.5 and 6.25, you're in a good spot right now. So let's go down and look at some of the economics we have, because once kind of the oil trade comes out of the play, after this conflict gets over, we're going to go back to see where are the basic economics in the economy, because that's what the Federal Reserve follows. So let's go back to that piece of it to see, okay, what do they follow and where's the markets going from here? Okay, so let's look at it this way. The Fed controls that rate over there. It's called the federal funds rate. What we follow, or what they follow, is the PCE on inflation and the jobs numbers. Okay, jobs have been steady. Even the Fed came out this week and said, we're really not concerned about the jobs report. But the PCE, that's the inflation numbers. They want that at 2. It's at 2.8. When oil back in January was $60 a barrel. So this is going to be well over 3. So now you're thinking, okay, the Fed's not going to cut. They're not going to cut anytime soon, because even if the oil and the conflict ends, oil prices aren't going to go back down to $60, $65 a barrel. So inflation's going to stay up. That's going to basically handcuff the Fed. Well, that's exactly right. So let's get over to the Fed Watch tool to see what the Fed's expected to do in 34 days. And we're going to do this every day because the probabilities of a rate increase, it keeps increasing. And the reason for that is the increased odds of a recession. So let's go down through here. The probabilities right now of a rate cut at the next meeting, 93% chance no. If you go down through here, you can see, well, there's really no more than a 50% chance of a rate cut until, next year. Okay, but the probabilities of an increasing rates are increasing a little bit. So I'm not worried about, the Fed increasing rates anytime soon. However, if oil stays above these levels for much longer, it could be catastrophic when it comes to inflation and all these things. So what am I expecting, or what am I advising my clients to do at this point if they're looking to buy a house? Well, keep looking. But here's what I want you to understand. Get pre-qualified at a rate like 7. And the reason being is, if you can afford that payment, you shouldn't have really anything to worry about, because rates should stay right about 6.5. So you should be in a sweet spot. But however, if they spike, can you afford that payment at 7? That's what you got to ask yourself. But if you're a homeowner right now, what can you do? I have a tool for you, but we're putting this thing on steroids. I'm going to have a demo this afternoon. Now, this thing, we're using AI to do this thing. It's going to track your rates, your payments. It's going to text you, email you, call you. It's going to do everything you need so you don't miss mortgage rates as they drop once again. So my expectations are this still, folks. I'm thinking rates, as soon as the war's over, no, we're not going to get oil back down to $65 a barrel. We could, but I'm thinking rates are going to drop. You're going to see inflation. Now, the next few readings are going to be up there. You and I know why. The economists will probably get it this time, but you're going to see rates sticking around about 6.5% until the war. There's at least some settlements here, and then you'll see them starting to kind of gradually go down. So if you're a homeowner, use this tool over through here. So it's RateWatch 2.1. Now I'm demoing a new version of this today that's going to overwhelm you. So watch today's demo. I will have it posted on YouTube just as a video as well. You're going to have to check it out. It will be live in the next couple of days. I'm working on the back end of all these things, but we don't sell the data, folks. It'll be me reaching out to you personally. So look at today's market is a minus 23 in bonds. Isn't good news for mortgage rates. You're going to see rates over 6.5% today, but all you have to do, folks, is just follow the oil market, because if you see oil going up, rates are going to go up. If you see oil coming down, rates are going to come down. I'm just hoping for some stability. So that's it for today, folks. Hopefully you learned a little bit more today on how we usually look at the economic data and those features on how they're affecting these things. But right now, the markets, their sole focus is oil and oil only. So that's it. Follow oil and you'll follow rates. Thanks for watching. Have a great day. Be safe out there, and I'll see you tomorrow morning and let you guys know how this ended for today and our outlook for tomorrow. Thanks. Don't forget to subscribe over there, so every time I post a video, you get an alert. You realize I have 8,000 videos? Check them out. There's got to be something down there that tickle your fancy. See you tomorrow, folks. Bye-bye.